Tolerance to risk. Now, this is really important, and you can see across the board as I talk to people, their tolerance to risk has dropped back a few notches during the global financial crisis. Now, really, that theoretically shouldn't happen. We should set our portfolio in place and ride out the waves, but often that's not. It's not what people are comfortable doing. But as a financial advisor, it's our role to ensure or coach people, encourage people not to get into the cycle of selling out at a low point and buying in at a high point. That's the worst possible scenario. And relating this to this discussion about your tolerance to risk, how much volatility in the market are you able to, or in your portfolio, are you able to handle? Because as we talked about earlier, the higher the risk, the higher the level of potential return, but the higher of potential loss, as we've seen during the GFC. The lower the risk, the lower the potential for loss, but also the lower potential to maintain the value of your money against inflation. So, the worst possible scenario is that if you are in a high risk investment, a higher risk than you're prepared to take. And if you saw your portfolio drop by 10% or 20%, and at that point in time you would like to get out of the market, you shouldn't be in that high risk portfolio.